All right, so welcome to chapter 2. Let's get started. So in this chapter, we're going to talk about financial statements and cash flow analysis. It's obvious, right? It's on the slide. So we're going to break it up into three sections. And first, we'll talk about financial statements, what they are, where they come from. And we'll do this rather quickly because you should have received majority of this information in accounting already. So not a lot of this should be very surprising. So when we look at financial statements or the way that we move around money, we look at two basic factors or two basic ways of looking at this money. We look at them in an accrual basis, and this is very popular with accountants, and it basically says we are going to record the revenues. The revenues are recorded at the point of sale and the costs are recorded when the costs are incurred. Now, at first, this might not make a lot of sense or a lot of difference. Why wouldn't you record them when they're point in sales? But the reason is that not necessarily all the money is transferred at the point of the sale. We look at it from a finance folks like to look at the cash flow approach, which is focused when the money actually moves. So this is when the sale happens, point of sale, and this is when when the money moves. Okay, this is the point of sale or expense. We call that the accrual-based approach, and the cash flow approach occurs when the money moves. What's the difference? Well, the difference is that sometimes we have relationships with vendors or with clients, and they walk in and say, "Hey, look, I need 3 pallets of 2x4x10 lumber or whatever," and you go ahead and let them have it, and they drive it off. That's when the sale is made. But the actual payment for that lumber could occur at the end of the day, or occur the next week, or the next month, and then we create, accounts payables and accounts receivables, and then we focus on the money actually coming in or out of the business. Those are the two differences. Um, and those are important because they dictate which financial statements or when the financial records are incurred in the financial statements. And so the big ones that we're going to focus on um, in this chapter are going to be the balance sheet and the income statement. These guys are absolutely crucial. Statement of retained earnings is an annual report that tells us how much money we're going to reinvest back into the firm. The statement of cash flows is a report that shows the money how the money moves inside the company. Those financial statements are important because they describe how or why we're making those decisions. But the big two we're going to focus on are going to be the balance sheet and the income statement. Okay, and let's do each of those independently. The balance sheet. The balance sheet should not be a big surprise. Well, neither one of these two should be a big surprise for you. Zoom in green. This is nothing more, the balance sheet describes nothing more than the financial or the accounting equation. The assets are equal to liabilities plus stockholder equity. That's it. Um, and the assets represent the total amount of value of a firm, right? How much money, the total amount of value, or how much money you have in the firm completely. And that money comes from two different places. It either comes from liabilities, which means usually debt to a bank or bonds or something like that, or it means that it has to come from stockholders' equity, which means, cash from owners. Cash from owners. So, if you're the CEO or the CFO of a firm, you want to know what your total assets are. But in order to get money into the company, we've got to come from somewhere. And there's only two places where they can come. They have to come either from liabilities, either you create a debt and then you get money into the firm, or you get somebody you convince somebody to give you equity or yourself, your own equities. And then that money also goes into the firm. When we add these two together, we have our total amount of assets. Yes, you're going to have to go back and make payments to debt. And yeah, the owners are going to want some sort of return, right? So they're going to get dividends back after your after your use of your assets, and these guys are going to get some sort of payments. But in order to create the assets to get your company going, you got to generate liabilities or equity. So this is what a balance sheet looks like. If we look at what the balance sheet on both sides, you see that we have assets here, and this whole side here, ugh, this whole side here, I'm still learning how to use this pen, is assets. And on the other side, we have, let me change the colors a little bit. We're going to have liabilities here and equity here. So very generally, what does that mean? It means I add these two together, and whatever these two add up to are going to be the same as assets. And you can see that here we've got 2012 and 2011, and the same 2012, 2011. So we're looking at 2 years worth. But if I look at the total liabilities and equities, it is the same as the total assets on the other side. And the same thing for 2011, right? This one is the same as that one. So that's the big equation. We've already assets is equal to, and on the other side of the sheet, liabilities plus equities. And now we're going to walk through it just a little bit. Let me see if there's a way to clear this thing. Stop inking. Can I do that? No. I want to ink some more. I don't know how to clear the entire sheet. That's all right. We'll keep going anyway. We'll just use a highlighter. Yellow. All right, so there's a couple of line items here that are particularly interesting and that we're going to use when we talk about ratios here after a while. The first one here is current assets, under assets. Current assets are short-term assets. They're stuff that can be turned into, that are cash or can be turned into cash very, very quickly. And then we have fixed assets. These are assets that the company owns that cannot be turned into cash very quickly. When we add them up, we get total assets. No surprise there. Current liabilities is stuff that we need to pay in the next 30 days or the first quarter. You'll see them here under accounts payable, notes payable, or whatever else. Long-term liabilities are liabilities that we need to pay over the next year, 2 years, 30 years. Maybe you have a debt in terms of bonds or whatever else. And then obviously we're going to add up our liabilities so we get total liabilities. Under stakeholders' equity, we're interested in preferred stock, common stock, retained earnings in particular, but we're mostly going to be interested in total stockholder equity. And then we'll talk about valuation of stock. Let me see if I can get another, so we don't get too confused. Here you've got your preferred stock and common stock. We'll talk about that in a second. We talk about PE ratios and market values and that kind of thing in another slide. The big important thing to get here is that the balance sheet represents a snapshot in time. A snapshot in time, which means today, tomorrow, on the 1st of January, whatever that one day is, this balance sheet represents what it is that the company is worth, how much and where that value comes from. So this represents how much the company is worth, and liabilities and equities represent where that value then comes from. Okay, an income statement is first, it's different from a balance sheet because it is not a snapshot in time. It is what occurs in operations over a period of time, say over 30 days, a monthly income statement or an annual income statement. Just yesterday, we had an annual meeting for a small business, and the very first thing we did is looked at our annual income statement and see how much earnings or how much money had come in. And we'll walk through an income statement here in a second. What's important here is that we are interested in income, right? That's why it's called an income statement. And how do we figure out income? We look at revenue minus expenses. So this basically means sales minus expenses is equal to income. And that is what we're interested in, right? We're interested in making income. Show me the money, all that kind of stuff. All right. But obviously it's going to be a little bit more complicated than that. So I understand this slide is kind of small, and it's got a lot of stuff in here, but this is nothing more than sales minus income. Okay, so let me use green for highlighters. So here we're going to start with sales revenue, right? So there's my sales revenue for 2012. And then I'm going to use pink to show all the different types of expenses. So what are they? Here's cost of goods sold. Cost of goods sold. And then after cost of goods sold, we have all of these operating, selling, and depreciating expenses, which we aggregate, right? So let me just highlight them all real quick. We're going to aggregate those together, and we get operating profit, other income, blah, 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 blah. And then we get earnings and taxes. So this actually goes up, and then we pay interest, right? Here, interest. And after interest, we're going to pay taxes. And then here are our taxes and what we're going to do in taxes. And that gets us to the big interest is net income right here. Net income after taxes. Excellent. From net income after tax, we'll talk about that in a second. But if we go back and look, we're just really looking at, let's see if I can get another color here. We're just really looking at 4 different major expenses. The first one here, one is COGS, right? COGS. The next one is going to be operating expenses, okay? And we can put depreciation in here, and we can put what we refer to as selling, general, administrative. You'll see this often called SGA expenses. All right, so that's number 2. And then number 3 is going to be interest. And then number 4 is going to be taxes. Okay, so these are our 4 major expenses. These are the ones that we're going to focus on big picture most often. And in between there, and we'll talk about again when we get to DuPont method, and in between there we have all the different types of profits that we have. So first we start with sales, we separate COGS, we end up with gross profit. We have gross profit, we subtract operating expenses, we end up with operating profit. We have then earnings before interest and taxes, EBIT. And you'll hear me say EBIT often, you'll see that a lot. This is basically earnings before interest and taxes. This is important because it just tells us, what we have as part of our core operations. Then after we subtract interest if we have debt, and that gets us pre-tax income. You'll see pre-tax income often called EBT, earnings before taxes. What's the difference? The difference is we've obviously already taken care of I, we've paid interest. Okay, so EBIT and EBT are going to be 2 separate numbers. And then so then we have pre-tax income, and then we pay taxes, which gets us to net income. All right. Net income, you may also hear it said as earnings payable to shareholders. Earnings payable to shareholders. It's the same thing as this guy right here, net income. Okay. And then I take that away and we keep going. All right, so there's 2 things that can happen here. There's 2 things that can happen after we get our, here it is, earnings available to common stockholders. That one right there, boom. Yes, there's preferred stock in here, but let's ignore that for a second. So earnings available to common stockholders, 2 things can happen after that. We can either decide to, come on dude, we can either decide to pay dividends, or we can decide to do retained earnings. And so our income statement is going to follow, our income statement is going to come all the way down here, and then let me visualize this in another way. We can either pay out, we either can keep the money in terms of retained earnings, or we can take this net income, this earnings available to common stockholders, and we can pay dividends to our shareholders. Okay, we either have retained earnings or dividends to our stockholders. And this constitutes the major internal decision process challenge to the CFO. We want retained earnings because we think we can then increase our sales revenue, but we also want to pay dividends because we want to make our shareholders happy. Smiley face. That's a terrible face, poor dude. Some ears. Right, we want to make our shareholders happy. Big Han Solo scar right there in the middle of his face.